investors look to the UK, vote as a sign of what is ahead for their money. My next guest says the exit says a lot about the signs investors already missed. Joining us right now is Macro Mavens President Stephanie Pomboy. Stephanie, good to see you.
Thank you.
Thank you so much for joining us.
My pleasure.
Well, you were so great over the years in terms of navigating what was a very tough market, and most people missed the macro story of 2015, that's for sure. So give us your take on Britain leaving the EU and its impact on the U.S. economy.
Well, I think it's really a wake-up call, and that was evident first and foremost in the market's reaction globally to the vote, that the economy, both here and around the world, is not nearly as strong as the markets have perceived them to be. I, as you know, have been hammering on the weakness in the consumer here in the U.S., and I think most constituents here, and again in Europe and the U.K., feel like this recovery has really bypassed them. It's a financial asset recovery, but in their world, they don't see it.
Why has the recovery been so weak?
Well, I think clearly the interest rate, the financial repression of these global central banks has kind of encouraged more financial engineering than real investment in the economy, hiring, capex, et cetera. We have had a jobs recovery, but it's been very poor quality. And I think what people overlooked as well was that there were scars from the bubble bust that had altered consumer behavior fundamentally. So consumers were trying to save, and then central banks came in and said, hey, we're going to lower rates and lower rates and lower rates. And suddenly they're like, well, if I want to save X amount, I've got to work twice as hard, three times as hard to do it.
That's true, John.
Stephanie, one of the effects of Brexit is that investors are pushing back the likelihood of the Fed raising interest rates. So we have an even longer period of very low interest rates. Does that help explain why the stock market is coming back today? So we might not be getting the earnings when you talk about discounted cash flows. Right. We are talking about continued very low rates as far as the eye can see.
Right. And this was kind of my concern, was that, I've been hammering on all the signs that the economy, if not already in recession, soon will be. And I now am convinced that when the second half rebound doesn't happen, it'll be blamed on Brexit rather than all the things that are actually wrong with the economy. I mean, take profits.
But do low rates help to justify the stock market values where they are? And will they continue to push stocks higher? Because we're now talking about the Fed maybe not raising rates at all this year.
Right. Well, first we've had 4 quarters of negative year-on-year profits right now. And I think what we're talking about is an environment where you're going to see probably another few quarters of that. Certainly Brexit increases uncertainty. You're not going to increase capex. It'll probably slow spending in general. But you also have this monster inventory overhang that still hasn't begun to work through earnings at all. And we're already down 4 quarters. So I think just before Brexit even came onto the scene, we were due for 2 more quarters of down earnings. So that's going to be kind of hard for the markets to square. Yes, you'll have more that there is no alternative, low interest rate repression, but on the other hand, if earnings are down, if they surprise and they don't rebound in the second half as expected, I think that could be a real wake-up call.
Can I ask, just as a layperson, my specialty is the psychology of politics, and what I noticed from the beginning of this was the use of emotion by the Remain people. The bookies were more moving what the markets were doing, what banks are doing, what people expected than the actual polls. And here we've got the emotion after the fact, that it was Armageddon, the sky was falling, a house was going to fall on all of our friends. And that seems now to have calmed down a little bit. How much do you work in that emotional response, the political manipulation of almost the Remain people wanting perhaps some failure to occur?
You're really looking at facts, though. You're looking at profits.
But I think that's a great point, though, about emotion, because the market's got it totally wrong.
Well, and Obama threatened on trade issues, and so there's that uncertainty. Doesn't that factor into it a degree, though?
Well, I think that's the point, is that the market got it 100% wrong. They were not in touch with the emotion of people who are actually going to the polls, who really were fired up. They're angry because they've been bypassed by this recovery. And I think the markets, I mean, if you look at I do these charts where I overlay, you know, the S&P versus the Consumer Comfort Index, and they used to move
Right.
together, and now they've gone like this for years.
Exactly.
And
But
so
the
there's
other thing
no
is
recovery on
the
Main
betting
Street.
markets and the stock markets fed off of each other, right? So people looked at the stock market investors looked at the betting markets and said, oh, they're saying that it stays, so they bet up stocks, and then that bid up the betting markets.
And the
that's
betting
what you,
is
that's what you see
is
in markets.
emotion.
People, they kind of chase the last move.
And now we
What today is the biggest risk to the U.S. investor then?
That they're missing a recession on the, you know, coming in the second half or in early 2017.
So you're expecting a recession in the U.S.?
Yes.
We've got the GDP out today. This is the final read of the GDP. Now, I know it can be backward looking, but it's been obviously horrible anyway.
Right.
What are you expecting from the GDP today?
You know, I don't really expect very much. I think that the real story will be the second half, because people have pretty much written off the first half, and the idea is you'll have an earnings and growth rebound in the second half now that the headwinds of the dollar and oil are fully behind us, and we can move forward. And now, you know, to the extent there is any disappointment there, I'm sure they'll blame it on Brexit, when in reality, you know, you do have a monster inventory overhang. You look at IS ratios across a variety of sectors are the highest since 2008. We have 20 months of declining consumer goods orders, which is an indication, obviously, of consumer weakness. The earnings, again, down 4 quarters, revenues down 5 quarters. These are not signs of a strong
Stephanie,
economy.
I'd say you're talking about consumers being the weak link. I would argue that business investment is the weak link here. It's been surprisingly soft. They can't figure out why it's been so soft.
I know
at the
why.
Fed.
It's regulation. The businesses are looking around the corner and not sure, you know, how they're going to allocate capital, given the fact that their healthcare costs have gone up, their regulatory fees have gone up, the financial services regulation. I mean, we've been talking about this entire program.
Certainly got to be a piece of it. There's a lot of other factors at play too. But how important a factor is that? Is the soft business investment?
In a drag on the economy,
Yeah.
I think? Well, I think it's both cause and effect. I think that part of the reason why business investment has been soft is obviously regulation, as you talked about, Maria, but also if they really felt that they could sell more merchandise, they'd be out there building plant and selling more merchandise.
So it's a demand story
I
as
think
well.
they also recognize that the consumer isn't quite as lively as he was before the crisis. Even saying that, they've left this monster inventory overhang. They've still been overly optimistic, even as cautious as they've been. So I think there are two sides to it. I think there's clearly the regulation hasn't helped at all. Obamacare hasn't helped business or consumers.
Right,
And
it's
that's
actually
also
hurt.
made it worse.
Yeah.
Quite a bit. Real quick, what do you need to see to feel better about where the macro story is? Is it the inventory, or is it you just need to see consumer spending?
I think you need to see consumer spending, but I think that's going to come about from real quality job growth and the business investment that's lacking that we're talking about. For me, that's the thing that could swing the economy in a positive way. Rather, you know, that's what I focused on for, you know, avoiding the recession.
Which is why tax reform, I think, is so critical.
And it's why these elections are so critical.
I was going to say, that's why there's so much uncertainty out there that a lot of investors, the U.S. average investor, fears getting into a market where we're in an election year and a lot is about to change.
Yeah.
No matter who is elected into office.
It's true. Stephanie, great insights as always. Good to see you.
Thank you so much.